If you're glued to the headlines right now, it honestly feels like you're living in two different worlds. On one screen, Bitcoin's back above $90,000. AI chipmakers are calling this once-in-a-lifetime demand. And stock markets are flirting with record highs because everyone thinks the Fed might start cutting rates next week. On the other screen, your rent just went up again. Groceries feel like a stealth tax, and your credit card balance refuses to come down. If you're thinking, why does it feel like there's a boom, but not for me? You're not imagining the squeeze.
And that feeling is not some personal budgeting failure. That's the system showing its seams. While Wall Street is throwing an AI and crypto party, you've got German industry talking about the deepest post-war crisis, Brazil getting hit with food inflation, the Indian rupee breaking 90 to the dollar, and rising political risk in places like Mexico. The thread running through all of that is what we're calling divergence. And it's the core reason your day-to-day reality feels out of sync with the headlines.
So that's where we're going today. We're going to sit with that tension and unpack it. Why financial markets are soaring while your wallet feels empty. Why your job can feel more fragile even when corporate profits look great on paper. And why your debt hasn't magically gotten cheaper. By the end, the goal is that you can say, okay, that's why my life feels like this right now, and see a few levers you still actually control.
Let's strip divergence down to something you could explain over dinner. Because from where most people sit, it just looks like a contradiction. Bitcoin and AI stocks ripping higher on one side, and on the other side, housing crises, food inflation, and central banks sounding nervous. Talk to me like I'm your cousin who just wants to know why everything feels so off.
All right, picture the global economy as a car with two engines bolted onto the same frame. Engine 1 is the shiny, turbocharged one. Financial markets, AI companies, crypto, big tech. The things you can buy and sell with a tap on your phone. Engine 2 is the old, heavy engine. Housing, food, transport, local services. The boring stuff your actual life runs on. When central banks even hint at cutting rates, Engine 1 roars to life immediately. Stocks, crypto, speculative capital, they all surge. Engine 2? It coughs, sputters, and barely moves.
So the dashboard looks amazing. The stock indices, the Bitcoin chart, the AI headlines all say, we're flying. But if you're in the back seat, it still feels like you're grinding up a hill with the handbrake half on. Your rent isn't falling, your loan payments haven't really shrunk, and the weekly supermarket run still hurts.
Exactly. Capital can flow into AI chips and crypto ETFs in seconds. But building affordable housing, training more electricians, or upgrading the power grid, that real-world infrastructure, takes years, regulations, and political fights. That's divergence. The part of the economy that lives on screens is booming, while the physical, real-world part you inhabit, your apartment, your commute, your job security, is grinding along. If you're confused, that's a rational reaction. You're being dragged around by two engines running at very different speeds.
And just to put some ground under this, while traders are betting on rate cuts, German construction is in recession. Housing in Canada and the US is basically at we've never seen it this unaffordable territory. And food and utilities are eating up bigger slices of paychecks almost everywhere. It's like we keep pouring fuel into the turbo engine while the main family engine is overheating.
Right, and central banks see that split. They see froth in AI stocks and crypto on one side, and on the other side, they see still high rents and sticky prices in services. Things like healthcare, education, and personal care that don't come down easily. So they tiptoe. They don't cut rates as aggressively as markets want. That's why your mortgage rate, your credit card APR, your small business loan, those borrowing costs aren't easing in line with all that market cheer you see on financial TV.
But let me push on this a bit. It's very easy to tell this story as, the game is rigged, regular people lose. And yet, this AI and infrastructure boom is generating real-world work. Electricians wiring data centers, engineers rebuilding grids, developers creating new tools. Isn't there a risk that if we frame this only as fragility, we end up sounding like all of this is just a house of cards?
There's absolutely genuine innovation happening. I'm not arguing that AI or new infrastructure are fake, but we've seen versions of this movie before. In the late 90s, the internet was real. That didn't stop the dot-com bubble from blowing up and taking a lot of workers' savings and jobs with it. In 2007, the financial engineering behind mortgages was real. So was the housing crash that followed. My worry isn't AI and crypto are illusions. My worry is the upside is clustering in narrow pockets, certain sectors, certain cities, while the risks and costs, higher living expenses, heavier debts, more job precarity, are spread across everyone else.
I mean, I hear that. At the same time, if we only hammer the downside, people mentally shut down. They go, okay, it's all broken, so nothing I do matters. And that's not helpful either. What I want for the person listening on the bus right now or folding laundry is, don't see this weird split, markets up, life hard, and conclude, I'm doomed. See it and ask, which engine is my life actually tied to? And how can I plug into the faster one without taking casino-level risks?
Yeah, I'm with you there. The message shouldn't be panic. It should be understand the wiring. The way I'd put it is, this boom is both real and fragile. AI data centers, chip foundries, energy transition projects, those can absolutely create durable opportunities, but they sit on top of a financial layer that's highly sensitive and tends to overshoot, both up and down. So your job isn't to perfectly time when the bubble pops, if there is one. Your job is to avoid making your household the shock absorber when things swing.
That's a powerful way to frame it. Yes, there's real risk. Yes, there's real opportunity. But the center of gravity for most people is, how do you live in a world where your rent and groceries belong to the slow, painful engine, while your job and your savings might still be able to hook into the fast engine? Let's zoom all the way into what people actually feel each month. Rent or mortgage, credit cards, wages, job security, groceries, small business stress. When you say divergence, what does that literally do to someone's monthly budget?
Think of your household as a kitchen with two big appliances, the fridge and the oven. The fridge is your fixed costs, rent or mortgage, utilities, minimum debt payments. It's always on. The oven is your variable spending, eating out, travel, subscriptions, little luxuries. You can turn it up or down. In a divergent world, the electricity bill for the fridge keeps climbing and never really comes back down. Meanwhile, the recipes you could cook in the oven get more elaborate because the outside world is booming. New gadgets, new services, more things you could spend on.
So the Netflix version of your life, the phone in your pocket, your laptop, the streaming and apps, keeps upgrading. But the boring base layer, roof over your head, food in the pantry, lights on, feels like it's eating everything. If you're thinking, why do I have all this tech but still feel like I can't breathe financially? You're not imagining that contradiction.
Let's make it concrete. Rent and mortgages. In a lot of places, housing supply is jammed up. You've got zoning fights, high material costs, and not enough skilled construction labor. Even when interest rates eventually drift down, you've still got a multi-year backlog of underbuilding. So, if you rent, landlords are paying higher financing costs themselves. New buildings are slow to hit the market. And people who can't afford to buy get pushed into renting, which adds more demand. Net result? Rents stay high. And in many cities, they keep inching up. If you own with a variable rate mortgage, central banks are cutting more slowly than markets want because they're worried about reigniting asset bubbles. So your monthly payment doesn't improve nearly as fast as the rate cut optimism headlines would suggest.
And that's the mind bender. You hear, rate cuts are coming. You might even see a celebratory headline about cheaper borrowing. But then your landlord emails you a renewal with a 7% increase, or your mortgage payment barely moves. Here's the tricky part. Housing is the biggest single line item in most households, and it's the least flexible one. You can cancel 3 streaming services before lunch. You can't just opt out of your lease.
Exactly. And you see a similar pattern with credit cards and personal loans. Lenders price in uncertainty. Even if the core policy rate drops a bit, they may keep their margins wide because they don't like the macro picture. Slowing growth, political noise, bubble worries. So your APR stays punishingly high, and revolving debt becomes this quiet treadmill you can't step off.
All right, now wages and jobs. Where does divergence show up on the income side?
You can roughly think of wages splitting into 3 buckets. First, the direct AI and infrastructure winners. People working on chips, data center construction, grid upgrades, higher-end software and cloud infrastructure. They're plugged right into that fast financial engine. They can see strong demand and decent wage growth. Second, AI-augmented but still essential roles. Skilled professionals like doctors, nurses, engineers, salespeople, complex operations roles. Jobs where AI is a tool, not a full replacement. Their productivity can increase, and if they negotiate well, pay can follow. Third, routine, middle-skill roles. Repetitive office work, basic support functions, undifferentiated services. Those are under real pressure. Employers expect more output, but individual workers have less bargaining power and see slower wage growth in real terms.
So you can literally have one person in a city getting poached with a 20% raise to go work on AI infrastructure, and their neighbor, who might be in a back office role or running a small retail shop, hasn't seen a meaningful raise in years. And then those 2 people are standing in the same grocery line, staring at the same higher prices.
Exactly. That's divergence as lived on your street. Now add in groceries and utilities. Climate shocks in places like Brazil or parts of Southeast Asia hit crops and things like palm oil, which feed into processed foods globally. Energy systems are strained. Europe dealing with the fallout from cutting Russian gas, emerging markets juggling weak currencies and subsidy cuts, and then AI data centers showing up and demanding huge amounts of electricity. That combo shows up as food prices that are higher and more jumpy, utility bills that spike and then never quite return to the old baseline.
If you feel like every 3rd or 4th supermarket trip is a nasty surprise, like your usual basket suddenly costs 10 to 15% more, that's the global system breathing down your neck. And when your paycheck feels flat in real terms, that volatility hits twice as hard.
Then layer on small business pressure. If you run a cafe, a clinic, a local shop, you're squeezed from all sides. Your rent is higher. Your inputs, food, energy, logistics, are more expensive. Your customers are under pressure and hunting for deals. But your bank still expects you to service that business loan at elevated rates. So on paper, you might see okay revenue. People are still buying coffee or booking appointments, but your margins are thin and your stress is constant.
And emotionally, that cocktail, high fixed costs, unstable input prices, customers tightening belts, feels like you're always one bad month away from the edge. If you're waking up at 3 a.m. doing mental spreadsheets, that's not drama. That's a completely rational response to the setup.
And we haven't even talked about financial confidence. When markets are roaring, but your personal finances feel fragile, you tend to drift to one of 2 extremes. You freeze, sit in cash, avoid decisions, and let inflation slowly erode what you have. Or you overreact, you YOLO into whatever's hot, trying to catch up in one heroic gamble. Both reactions are understandable, and both are shaped by this environment of divergence. They also both risk making you more vulnerable to the next swing.
So at the wallet level, the story is income that's flat or gently rising, fixed costs that are high and sticky, essentials that are more volatile, and a constant noise of other people are getting rich off AI and Bitcoin. If you feel like you're running harder just to stand still, that's not a character flaw. That's the structure of the current moment. Let's zoom back out, but keep it practical. I don't want to do crystal ball nonsense, But let's sketch two plausible paths. One where the system leans more toward resilience, and one where the fragilities really bite for a while. Just if this, then that story so people can see where they might intersect personally.
Okay, let's start with what I'll call the resilience path. In that world, central banks manage a slow, cautious easing. They cut rates gradually, keeping just enough pressure to avoid a massive speculative blow-off. AI and infrastructure investment keeps flowing, but doesn't completely overwhelm power grids or trigger unmanageable price spikes. Governments lean a bit into housing supply, smoother permitting, and basic safety nets. If that's the path we're on, some routine jobs are lost or reshaped, but new roles in energy, infrastructure, and applied AI absorb a good chunk of people. Your rent probably doesn't drop, but the crazy year-to-year jumps calm down. Food and energy remain uncomfortable, but they're stable enough that you can budget and gradually build a cash buffer.
In your actual life, that version feels like the squeeze is still there, but you can plan around it. You can say, all right, I'm going to pivot closer to sectors that are hiring, level up one specific skill, refinance this one debt when the window opens, and get my savings at least partially into assets that benefit from growth. It's not a fairy tale recovery, but it's a world where steady, deliberate moves actually pay off.
Now, the fragility path. In this scenario, central banks mistime things. Either they cut too slowly and parts of the real economy tip into recession, or they cut too quickly, asset bubbles inflate further, and then burst. AI-driven power demand slams into underbuilt grids, causing renewed energy price spikes. Climate shocks keep hitting food production in clusters, so food prices rise in waves. Political risk, like you're seeing in Mexico or some European pockets, spooks investors and credit markets. If that's where we end up, certain regions see sharper job losses, especially in already stressed industries. Housing affordability actually worsens in safe cities as more people crowd into them, while weaker regions hollow out. Currency pressure gets uglier in parts of Latin America, Africa, South Asia. Local savings lose global purchasing power faster.
And if you're living inside that version of events, it looks like surprise layoffs in your industry, a nasty rent jump at lease renewal, another leg up in your grocery bill, and your local currency not going as far when you import anything or travel. It's not destiny, but if we do get that version, the households that fare better will be the ones that treated this current period as a warning shot, not just background noise.
And the key thing is, in both paths, the main pressure points, housing, essentials, job sorting, don't magically vanish. They evolve, but they don't disappear. The difference is whether you've capped your fixed costs where you reasonably can, built even a small shock buffer, and nudged your skills and your savings toward the parts of the economy that actually have momentum.
So when you feel that tension, markets up, life hard, the useful question isn't, can I perfectly predict which path we're on? It's, in either of these worlds, what can I do now so I'm less exposed to the bad version and better positioned for the better one? Let's land this. If you're listening and your dominant feeling is, I'm exhausted, I'm doing what I can and it still feels like it's not enough, I want you to really hear this. You are not crazy, and you're not uniquely failing. You're living through a stretch where the financial engine of the world is revving like mad, while the household engine is misfiring. It would actually be strange not to feel stretched.
And the reason this feels scary is because it is scary. Housing, food, and debt are not lines on a chart. They're the foundations of your daily sense of safety. But scary doesn't have to translate into paralyzing. The uncomfortable truth is that doing nothing, waiting for rate cuts to magically fix it, or hoping AI somehow trickles down in a neat way, leaves you squarely in the blast radius of any shock.
The quieter, more hopeful truth is that you do still control a few important levers. How much of your monthly income is locked into immovable, fixed costs? Whether your savings just sit idle or are at least slightly tied to real growth. And whether your skills are anchored in shrinking roles or moving toward expanding ones.
If any part of you is thinking, maybe I can shift my trajectory a bit, take that seriously. You don't need a 50-point playbook. Think in threes. One step to harden your personal balance sheet. One step to upgrade where your savings live. One step to edge your career closer to the more resilient parts of the economy.
So next time you see a headline about Bitcoin, Nvidia, or some giant AI project, don't just file it under someone else's world. Treat it as context for why your life feels the way it does, and as a reminder that the gap between the booming market story and your own wallet has a name: divergence. Once you can name it, you can stop blaming yourself for it and start positioning so it doesn't roll over you.
You're not going to fix everything in a week, but small, boring changes made with clear eyes will usually beat waiting for the system to suddenly remember you exist. In a fragile boom, real resilience gets built at kitchen table scale. One budget, one skill decision, one financial choice at a time.
Thanks for sticking with us. If anything in this conversation hit a nerve, don't just nod and move on. Before the day ends, write down one concrete change you'll make in the next month. That's how this stops being just another interesting but anxious episode and starts being a quiet turning point in how you move through this economy.
And remember, what's happening out there is big and noisy, but your response doesn't have to be. It just has to be intentional.
Disclaimer: this conversation is an informational synthesis of recent data and does not constitute investment, legal, tax, or financial advice.